Welcome to vTalkInsight, Market Drivers Daily for May 11th, 2026. Geopolitics, energy, artificial intelligence, and inflation are all pulling hard on the cross-asset tape today, with oil back above $100 even as AI leaders push global equities to fresh highs. Let's start with how the latest Middle East tensions are reshaping the risk premium in oil and rates. Escalating Gulf tensions are again anchoring macro risk. The United States and Iran remain deadlocked, each rejecting peace proposals, while Iran signals leverage by deploying submarines and keeping pressure on the Strait of Hormuz. Brent is now above $104, West Texas Intermediate near 98, and both oil and European gas prices are climbing as a more persistent risk premium gets embedded into energy. Compared with late last week, when crude had drifted lower on de-escalation hopes, the tone has swung back towards stalemate and disruption. The shipping choke point remains constrained, and producers with limited pipeline bypass capacity, including Iraq, Kuwait, and Bahrain, face mounting financial and production stress. Saudi Aramco's leadership warns that if Hormuz disruptions persist for weeks rather than days, the market may not fully normalize before 2027, pointing to a longer horizon for tight supply and elevated prices. These pressures are spilling directly into rates and volatility. Rising oil is helping push global bond yields toward 4%, with European yields also grinding higher on inflation worries and political uncertainty. Implied equity volatility, reflected in the VIX above 18, has ticked up, yet global stocks remain remarkably resilient. Energy producers and oil-heavy indices, such as the FTSE, are drawing support from stronger earnings, partly offsetting broader geopolitical concerns. The core macro risk is that an energy shock morphs into stagflation, especially in Europe and more fragile emerging markets. Prolonged disruptions are eroding global oil inventories and driving diesel crack spreads back toward conflict-era highs, while shortages of diesel, jet fuel, petrochemicals, and fertilizer raise the prospect of higher transport and food costs later in the year. That combination could squeeze lower-income consumers, pressure corporate margins, and weigh on global growth even if headline crude stabilizes around current levels. There's also a more benign scenario in play. Brent has settled into a $100 to $105 range. Spot cargo premiums for some North Sea grades have eased, and United States jet fuel stocks remain above seasonal norms. European allies are planning a defensive naval mission for Hormuz, contingent on a stable ceasefire, and markets appear to be pricing a messy but manageable status quo rather than imminent escalation. For portfolios, the risk is that current pricing still underestimates the odds of renewed kinetic conflict. Signals from the upcoming United States, China summit on Iranian oil purchases, progress on sanctions enforcement, and hard data on inventory draws and diesel cracks would determine whether energy stays a background risk or becomes the dominant macro shock that finally challenges today's equity optimism. While geopolitics drives the headlines, artificial intelligence remains the central engine of global equity performance. AI-driven enthusiasm has helped push major indices to or near record highs, with semiconductor benchmarks up roughly 66% year-to-date, and some strategists now lifting S&P 500 year-end targets from 7,700 to 8,250. In Asia, Korea's Kospi has surged more than 230% since last April amid dramatic earnings growth, yet is still described as historically cheap on forward earnings. Under the surface, the demand story keeps accelerating. Agentic AI and autonomous software agents have driven a step change in compute usage, with token generation growth shifting from around 20% to well above 120% since early 2024. Hyperscalers are projected to spend over $800 billion on capital expenditure, largely for AI chips and data centers, while model builders report revenue ramps from single-digit billions to more than $40 billion in a matter of months. This is forcing a multi-year build-out of power infrastructure and electrical grids, with companies spinning off dedicated cloud and power businesses that guide to 65 to 75% revenue growth this year and even faster next year. The rally, however, remains narrow and highly concentrated. A small cluster of semiconductor names is estimated to account for the majority of S&P 500 gains and a large share of emerging market index performance. Asian tech and chip stocks are clear winners, Korea, and Taiwan are highlighted as preferred vehicles for the global AI boom, with semiconductor earnings in the region up well over 100% year-on-year and indices rallying despite Middle East tensions. Even emerging market AI leaders are seeing valuation multiples compress as profits catch up with prices, underscoring how much of the growth narrative is being validated by earnings. Alongside the euphoria, concerns about concentration and valuation are mounting. Some megacap names, such as Alphabet, have seen sharp multiple expansion on the back of heavy AI investment, prompting selective profit-taking and rotation into more attractively valued sectors. Software stocks perceived as vulnerable to AI disruption have been sold off indiscriminately, and hedging concentrated AI risk is proving difficult as retail demand for call options and leaders like NVIDIA meets professional selling. On the funding side, hyperscalers and AI platforms are issuing large amounts of corporate debt, with their aggregate borrowing approaching that of the financial sector, and new AI deployment vehicles are being marketed with very high implied returns, raising questions about future credit and bubble risks. Supporters of the current rally argue it is not a repeat of the late 1990s. Strong earnings growth is doing much of the heavy lifting, with the median S&P 500 company growing profits around 14% and headline tech and hyperscaler earnings closer to 26%. Asia-Pacific technology earnings are up more than 160% year-on-year, and big tech investments, from Microsoft's multi-hundred billion-dollar AI stake to Apple's upcoming ecosystem-focused AI strategy, are backed by real cash flows rather than pure speculation. Looking ahead, many expect AI leadership to broaden from chips into software, consumer applications, and even energy infrastructure. But the same capex boom that powers growth today is also feeding into the inflation story we will turn to next. Inflation risk is back at the forefront as energy shocks intersect with robust growth and AI-driven investment. Rising crude, with West Texas Intermediate near $98, is pushing up transport fuels, while United States diesel prices have surged sharply and gasoline averages around $4.52 per gallon, reviving political pressure. Historically, spikes in diesel, the workhorse fuel of the economy, have tended to foreshadow higher consumer price inflation, especially if elevated prices persist. The inflation impulse is not just about headline crude. Diesel crack spreads are back at conflict-era highs, and disruptions to petrochemicals, helium, naphtha, and fertilizer are feeding into core goods costs. Supply bottlenecks in fertilizer, in particular, pose upside risk for agricultural commodity prices as planting and harvest seasons progress with insufficient inputs. Several emerging markets are already feeling the strain, with India, for example, facing higher fuel import costs, currency pressure, and government appeals for energy conservation. If the Strait of Hormuz remains impaired, some scenarios even contemplate United States gasoline moving towards $6 to $8 per gallon, which would intensify both inflation and growth concerns. Incoming data are reinforcing the reflation narrative. United States consumer prices are expected to reach about 3.7%, the highest since 2023, while core PCE, the Federal Reserve's preferred gauge, is rising faster than headline CPI, partly reflecting large-scale infrastructure spending by big tech. In China, April inflation surprised to the upside, with consumer prices around 1.2% and producer prices near 3%, both above forecasts and driven largely by higher energy costs and strong demand for AI-related exports. Yet short-term inflation expectations in bond markets have not fully priced the risk of extended energy disruptions, leaving yields vulnerable to further repricing if shocks persist. Monetary policy expectations are adjusting quickly. Persistent inflation above target and a resilient labor market have led many participants to push out Federal Reserve rate cut expectations, with some now seeing no cuts until 2027 and even entertaining the possibility of another hike. Yields are grinding toward 4% in the United States and moving higher in Europe and the United Kingdom, where talk of possible insurance rate increases in June is gaining traction amid oil-driven inflation worries. On the fiscal side, proposals such as suspending gasoline taxes or expanding consumer support aim to cushion households but risk embedding inflation further, while a contrasting approach, like Australia's focus on budget repair, highlights the trade-off between growth support and price stability. There are still credible disinflation forces in play. Recent wage growth moderation and steady jobs data support the case that some inflation pressure could prove transitory, and inventory buffers plus strong United States energy exports are, for now, capping an outright supply-driven oil spike. China's producer price gains are not yet fully passing through to consumers, and over time, productivity improvements from AI and broader technological innovation could echo past episodes where growth and profits rose without runaway inflation. For now, market pricing still implies inflation drifting lower into year-end, but with wide uncertainty bands. The key watch points are upcoming United States CPI, PPI, retail sales, and jobless claims, as well as central bank communication around the Federal Reserve leadership transition. Together with the evolving energy story, these will determine whether the narrative tilts toward a contained reflation or a more challenging mix of higher yields and slowing growth. Across today's session, a few themes stand out. Gulf tensions are embedding a more durable risk premium into oil and rates, even as equities, led by AI and semiconductor names, continue to grind higher on powerful earnings. At the same time, accelerating inflation pressures from diesel, gasoline, and supply chains are pushing bond yields up and forcing markets to rethink the timing and direction of central bank policy, particularly in the United States and Europe. Watching how these strands resolve, energy flows through Hormuz, the durability of AI capex and earnings, and the next round of inflation data will be critical for assessing cross-asset risk and opportunity over the coming months. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.